All right, Jeff, thanks for hopping on today. I'm excited to dive in with you. You've done so much in your career. I don't even know where to quite kick it off, but would love to hear what you're currently focused at inside of Happy Money. You came on not as a founder, but as a CEO. I believe you came on as the interim CEO, but maybe to kick off the conversation, tell me about that. Tell me about it.
So I joined Happy Money 1 year and 11 months ago. And I actually joined as the CTO. Prior to this, I was the CTO at Marcus Bank at Goldman Sachs. Primarily, the thing I did there was led the team that built the Apple Card. But I wanted to get back to startups. And I liked the mission that Happy Money has, which is to build products that help people have a happy relationship with their money or use their money as a tool for happiness. And I wanted to get back to startup land, be more a part of that. Goldman Sachs is awesome. Actually, they have a great culture and stuff, but it's not a startup. And so when I was looking around, I found Happy Money. They were in a great space working with the credit unions, providing these initial product of the payoff loan, which is a loan that pays off your credit card debts. And they were also in a place where they were truly a technology platform. Essentially, we facilitate loans. We don't make loans. And on top of the credit unions. And that struck me as an interesting place to be. So we had a common interface and we were driving demand and creating loans and servicing loans and then putting them on the books of the credit unions that we work with. And the credit unions are an interesting beast because they are not-for-profits, tax-exempt organizations. So they have a good cost of funds. But as banking is becoming more and more and more technical, I think we all know the sort of deconstruction and reconstruction of all these financial services is happening. It's not like we invented that. That's just been a trend for 10 years or so. And these folks that are not of this gargantuan size have trouble competing. And so it was interesting to me to build a platform that sits across all of them and then to start to offer their services through that platform, sort of like one giant institution stitched together from all the credit unions, but for the benefit of the credit unions. So that's where we're headed right now, is that partnership where we sit on top of the credit union balance sheets. And then we increasingly offer initially more kinds of loans, including we're going to offer an API shortly, in a month or so, that'll go live. And the API will allow people to make unsecured loans to individuals using the credit union's balance sheets, facilitated by us. So we do everything. We underwrite, we fund the loan, we take the payments, we distribute the money to the credit unions, we distribute the money to the person. So it really is reminiscent of how the payment services do everything for you. If you sign up for a payment service, you don't have to do anything with money. All the money just happens. And the same thing will be true with our API for lending.
Awesome. I'm curious, why are the credit unions still in the market? Is there some regulatory category in being a nonprofit that they have a strong competitive advantage against either say bigger banks or other places to raise capital, not raise, but to borrow money?
Right. And so it's not exactly regulatory, but because they are not-for-profit for the benefit of their members, they don't pay any taxes. And so, but that also means they're not-for-profit, right? All the benefit of whatever they do goes to their members. So that means they have a low cost of funds, a traditionally low cost of funds. The problem that they have competing is that some of them are quite big, but none of them are at the scale of a Chase Bank or Citibank or someone like that. And so in a world of tech, they have trouble competing for employees. They have trouble building critical mass to build the tech. And that's sort of the area that we would like to address from them. The other thing that credit unions do enjoy, probably because they've been for the benefit of their members for so long, is they have a lot of loyalty from the people that work with them. And they traditionally have offered secured lending products, auto and home. I don't know if you've ever touched a credit union or not, but it was a very common way to get an auto loan, and it still is. They have a lot of indirect auto through the dealerships. And they power a lot of mortgages as well. The same idea. They have a low cost of funds, and they provide for the benefit of their members. They've had traditionally difficulty offering unsecured lending. it's a different world. It's shorter term. It's higher rates. It's a little harder to manage. And so that seemed like a good opportunity for us to say, you're good at getting deposits. You have a high trust from your members. We'll build the technology and a technology platform to handle all the heavy lifting of doing the lending and servicing the loans, and then we'll work together, right? And so it truly is a platform where we work together. And our interests are aligned, right? We want to make more high quality loans. We have a lot of restrictions on the loans we make because we want to make products that make your life better. So we want to ensure that the loan contributes to your happiness, doesn't contribute to your financial stress, is super transparent, has no penalties and things like that just sort of sometimes get people in trouble. We don't want to have those kind of loans. And we're kind of fortunate that our credit union partners are all really aligned with that philosophy. So
what are those? Like, what would be a loan that I take out voluntarily as a consumer, as an example, that would be make me unhappy or make me is bad for me?
So there's sort of two examples I can think of. Like the first example would be credit card debt. So credit cards have a very high interest rate. The minimum payment on many of them, if you calculate it, you've taken like a 15-year loan, right? Because the minimum payment takes a very long time to burn down the debt. And then the third thing, which people don't often understand about credit cards, but possibly you do, is that once you carry a balance on your credit card, all of your purchases start earning interest from the minute you make that purchase. So it also becomes a less useful vehicle for you if you are in the place where you're revolving, where you're paying that. And so one of the things we do is we help people to take that, put it on typically a lower interest rate loan, which is fairly easy to do with credit cards because the interest rate's very high. And then on a shorter term, say 2 to 4 years. We have a lot of flexibility on that because the credit unions do not securitize their loans. And so we don't need to conform to something that we packaged up and sold. But the idea is to create a loan and a monthly payment that will get you out of your debt in a reasonable amount of time, has a better interest rate, but won't put you in a place where you're like, can't make your monthly obligations, where you're stressed out doing that. So we don't strictly adhere to ability to pay. We go to a lower ratio than that, where we think the ratio won't cause stress, right? And then the second one.
Sorry to interrupt you. Go for it. I was going to ask you, though, on the credit card, how can the credit cards get away with charging as much as they do? Is there just not a competitive economic force to them? Are they just so easy to get because they have direct ties with banks? Or I'm wondering how are they, they can charge exactly what they can get away with charging, meaning that if somebody offers a cheaper option, then they would have to lower their prices. But their prices for the interest rates are so high. Is that because it's just, I'm curious what your thoughts are on that.
So, I don't know, but when I think about how a credit card works, so take a spending on your credit card versus proactively getting a debt consolidation loan with us. Like if you were to think about just spending on your credit card, it's like this incremental thing. So, you boil the frog slowly, and then the person has this breaking point. Credit cards are fantastic. Like if you use a credit card properly, it provides huge consumer protections. You get points, you get deals. There's all sorts of things if you use it properly. They're a fantastic vehicle, right? They also are more and more actually transparent with the dynamic of I'm doing my monthly spend, and now I tip over to the place where I can't make the whole balance. And so when I bought the credit card or applied for it and got the credit card, I probably was thinking about things like the benefits, the points, the lounge access, all the stuff that's important to you about which credit card you use. However, and I probably didn't look at what is the rate if I'm revolving. And then when you tip over into it, now you're at this place where all of your spend, and if you're like me, all of my spend is on credit cards because I like the points and it's convenient and I never carry any cash. Now you're at a place where all of your spend is earning interest, and it's very difficult to dig yourself back out of the hole. So I think the reason is that when the person's selecting the card, they don't think in their mind about, well, what happens if I start to pay interest on this card? Whereas like for a debt consolidation loan, people are very price sensitive because that's the only thing they're thinking about is what's it going to cost me to pay off all this debt? And so I think that's why the unsecured debt consolidation is more competitive, is because it's a lot easier for people to compare on prices. And it's also the thing that's like front of mind for them is how much is this going to cost me? I'm not, we don't actually know why some people get in credit card debt and others don't, but
Yeah. Yeah, no, I think you're hitting on the right concept though. The idea of the frog boiling slowly. I would imagine most people are not going into a credit card thinking that they're even at risk of not paying it off. I'm sure there's statistically some who do, but it is kind of surprising how expensive it gets if you don't pay it off each month. And I think there's a level of like financial knowledge that you can accumulate or don't accumulate in the education that you have, especially if you're in your 20s. I feel like if you're first kind of getting into the real world and managing your own money and balance sheet, and credit cards are appealing. You get what you want now and you have to pay for it later. And so if you're the personality type, I think it probably skews personality type, impulsive. It's hard to know exactly, but there is that, there's some people who just only care about, let's do it today. We'll figure out a way to pay for it, figure out a way to fund it. I mean, you see this in like politics in the macro sense too, where that debate is like, where are we in terms of a debt to the country or debt to individuals? And how likely are we able to pay that off in the short or long term? And it's hard to know, right? You can be optimistic. I'm sure you see this in tech where it's like, we're going to hit 1 billion users. We're going to hit $1 billion in revenue, $1 billion valuation. And you place a bet on that as an investor or as a founder or employee that you're going to make that journey happen. But you just don't know how things change. Right. So I think that trickles all the way down to individuals. I'm going to get that job promotion, and then you lose your job. It's like, right. Yeah. So
it definitely can happen that people get into trouble because of an unforeseen life event. I mean, that happens to people. I think what the phrase you were looking for, and it's actually interesting because there's two things I think that lead to it. One is intrinsic to the person, which I think you were looking for the phrase of delayed gratification. Mm-hmm. And we all know the people that can have delayed gratification in general do more successful in life, but it's like an intrinsic characteristic. So if you don't do that, then when you get a credit card, it's like you have this little like device in your hand that just feeds into that trait of yourself. Like, I'm not good at delayed gratification, so I'm going to just get this thing I want it right now. And then the second one is education. And for me, I was pretty fortunate growing up. And my parents, when they talked about me getting a credit card, first of all, they told me not to get one for a long time because they thought I was too young, and young people don't have the best impulse control. And then when I got one, they were adamant, you pay it all every month. And so that was a good lesson to start life with, rather than to have to learn that the hard way by running up a whole bunch of debt and then paying it off. Yeah,
it can be really painful to go through that process. And also just the credit. I mean, we don't have to go down the road, but man, you accumulate bad credit score as a young person, and then you don't intentionally make moves or make decisions in your life to build that credit back up because you don't know how to do that because it's very black boxy and it's not explained to people. So it does seem like we have a long way to go in terms of educating young people on how to build financial credit and make smart moves. I did read that the Federal Reserve noted that 30% of Americans don't have enough cash to pay a $400 emergency, which is pretty wild to me. Yeah, some of the stats. Another was credit cards and mortgages account for 2/3 of American consumer debt. And the average consumer debt is worth 75% of US GDP, which seems pretty daunting. I mean, if you think about it on an individual level, like, okay, how much do I make per year? And then if 75% of that I'm in debt, it's a lot.
Yes.
I want to ask you a bit about the relationship between the business models of Happy Money and the credit unions. So it seems like with the credit unions having this nonprofit classification, they don't have to pay taxes, but in return for that, they have to reinvest the proceeds, the profits of the company. They have to distribute them to the members as opposed to reinvest that back into the company. So there's kind of this there's this drip or this counterforce to growing large. You know, if they could just reinvest that back into the company, then they'd have a huge advantage. Do you see like Happy Money bolting on to the nonprofits as a way to grow the credit unions? I mean, do you see Happy Money as like bolstering up the credit union market, whereas 5-10 years from now, we might see massively large credit unions, or does that not make sense?
It could do that. I do believe that what we're trying to do is to build a platform that integrates all the credit unions into a single entity for a lot of purposes, like for the purposes of providing loans. And then that allows us to build operating efficiency. It allows us to build marketing across all of those. We have a direct consumer business as well that we work on. We have a loan participation network for the very small credit unions. And I think it might result in one or two of the credit unions. We are partnered with some of the biggest ones in the country. One or two of them growing in an outsized fashion. My hope is what it does is it revitalizes the whole industry, and both the big and small can continue to survive. And then we have that sort of like really diverse takes on different kinds of credit unions that provide things for different people, and that they all can succeed well because they have a platform that lets them participate in what's happening to banking being consumed by technology, right? That's happening, right? Mm-hmm. Whether anyone wants to do or not, that's happening. Whether Happy Money does anything or not, that's happening. So my hope is that we can be the platform that lets them play. And the analogy I use in my mind, and it's far from perfect, is the way that Shopify lets people play versus Amazon. Because it's millions of small merchants. They all do pretty well. Shopify is a fantastic product, right? Through that platform. And if I think about how would thousands of credit unions and maybe even community banks at some point keep their sort of local or small community touch, but participate in this giant platform that enables them to have a nationwide reach, that then enables them to be commercially successful and do even better for their members. That's what I hope happens. It could do what you're also saying, like take a few of them and grow them to outsized credit unions.
Yeah. You're right, though, on the trend of technology impacting pretty much everything in the world, but certainly everything in the financial space. What are the other noticeable trends on fintech that you're seeing? So you were at Stripe previously. You were at Marcus with. Oh my God, I'm drawing a blank. Goldman Sachs. Are these? Do you see a desire to get to consumers directly? I mean, Happy Money touches the consumer financial portion of it directly. You know, you're primarily thinking about building a brand, building an appealing message and services that help individuals. Is that the tip of the spear in terms of where innovation is on technology in fintech, or do you view it as across the entire stack or somewhere else specifically? Yeah.
So I see sort of two trends. One is like Marcus Bank at Goldman, this idea that financial institutions will be entirely digital institutions. Goldman has no branches, right? And that's a big advantage to them. They don't have to pay for them. They don't have to run them. It's an entirely digital experience, which is what many consumers want. And that's how they're getting in front of the consumers directly. And I think that the big banks in particular, like the Citi, the Chase, Goldman, are well equipped to do that. They can hire big teams of developers. They can produce fantastic products that like stand toe to toe with other things in the app space or in the web space, right? The credit unions are not so well equipped to do that. But I think they can take advantage of the second trend, which I think is more powerful and ultimately will win out, is that many of the already successful consumer applications are looking for ways to include the appropriate financial services within their application and still maintain first touch with the consumer. And I think that trend will just continue to accelerate. I don't actually even know if that's controversial. If you were to look at Amazon, Google, Facebook, all of them are pushing their way into the kinds of financial services they think their users want. And if we can provide a platform that powers that and enables them to do that, deal with the regulatory complexity, deal with fraud, deal with the money movement, then I think that trend will continue. And just as maybe partly because I spent almost my entire career in the Valley, I think it's going to be hard for, in the long run, the banks to win first touch with the consumer.
Yeah.
Maybe the giant ones will, but for like a little local bank to win first touch with the consumer, that feels like that's going to be really difficult to me.
Yeah, because they're competing on a different playing field. I mean, you basically invested in this business 30 years ago, 40 years ago, whenever you started, and you're investing everything into the people, the culture of the bankers, the real estate location. I mean, some of these are just like downtown and major cities. And then we go digital, we have a pandemic, and then literally no value, probably negative value is placed on having a physical location. And so to your point, I almost think when you said earlier, one thing that caught my ear was you're drawn to Happy Money because you wanted to be in startups. I think of it as like Stripe. Could you call Stripe a startup at this point? No, but what makes them unique is that they were built from the ground up using technology as opposed to JP Morgan or Goldman Sachs that are fundamentally built from the ground up, thinking banking first, just purely based on when they were started. And so they have enough money where they can bolt on great technology. I listened to a podcast with Patrick Collison, the Stripe CEO, and he was saying this. He's like, somebody asked him, why is it that a company like Chase, which has virtually infinite money, just can't build a very compelling user interface online? And it's some combination of smart people and talented people don't want to work at these companies. And it's difficult for these companies to decipher what talented people are and how to organize them within their company and how to integrate them within their company. And I just found that kind of mind-blowing, that it's just not, that there's such an enormous advantage of companies who start from the ground up with software. Do you have any, maybe not advice, but things you've learned from having been in both worlds? If people are listening and they're in large companies and they're like, we have to make a change to technology, but they're feeling like it's a daunting task?
I do have some thoughts on it. So one, even tech startup companies, even Stripe, fantastic company, has old technology as they go along, right? That they have to replace if they want to keep up. But what they've built is a process that's twofold. One is they are focused on the technology and they are driven by technologists. They are not driven by people who are bankers or people who are, or whatever your industry is. If people focus on the industry rather than technology, they have a different focus. And so when a Stripe or someone does that, they are iterative. They understand what it means. They keep in touch with advancing technology and they quickly move to the new technology. The second one is that in a company like a Stripe, or as Happy Money is becoming, or almost any startup, engineering is central to the company. And it takes a long time for an existing organization to move from, like, the bankers are the central thing to engineering as the central thing. I think that's why Goldman started I don't know why they started Marcus, but I think that's why they started Marcus, was to take this small organization and set it off to the side and say, hey, this organization does banking, but it's about tech. Rather than we do banking and tech's a side thing, right? And I think that if you don't have tech as your central thing, then a lot of the ways that you run the company, the iteration, the rapid experimentation, the attracting the best talent, just are much, much more difficult.
Yeah, agreed. It's kind of like trying to boot up culture from scratch. It's possible if you create a new entity within your organization, like Marcus is the Goldman Sachs, possible, but it's difficult if you do it ingrained in the existing culture. I mean, how many times you hear of founders who start a company and then they have an acqui-hire or an acquisition, and then it just fizzles out within the parent company because the dominant culture of the parent company just doesn't quite mesh. People aren't productive. They aren't happy. They get distracted and they leave. Yeah. You guys now are, Happy Money is over $1 billion in valuation, raised 150, 60 million, somewhere in that range.
Total. Yeah.
Total. Yeah. It's certainly now in the category of like beyond startup. Do you see the credit unions? I guess let me ask you this: do you see the way that lending happens and money movement as becoming completely withdrawn from humans? So credit unions and banks they'll look at your credit score, they'll look at your sources of income, they'll look at your savings in various locations, and they'll make a decision, whether it's an auto loan, a business loan, a mortgage, etc. Do you view that as we're just in this middle ground until it becomes fully automated, where you just connect APIs to whatever sources you have, and then it's like yes or no, or how much?
Yeah. So what you're talking about there, we call underwriting, right? Basically, are we going to give you the loan or not? And I do think that in short order, I don't know, 5-ish years, 10 years, all underwriting will be nearly 100% automated. And part of that is just the amazing increasing capabilities of things like AWS, right? Like if I want to see a picture of your driver's license and know it's you, I can use Amazon recognition and it can tell me the right answer all the time. And so I don't need a person to do that, right? If I have a document and I need to read it and parse it, they have services to do that as well. So, so part of it is just that, like the point tasks that the person does are becoming more and more able to do with the advanced technologies offered by the cloud providers. The second one is that as more and more of the sources of data become available programmatically, like think of something like Plaid, right, where I can see all of your transactions, or even there's automated payroll verification services, then there's less and less need for a person to do things. And so I think it will become like a totally automated process that doesn't like support the conclusion that won't take into characteristics anything about you as a human. So like one of the things that we do is that we think of underwriting in roughly 3 stages, and it's kind of like I don't know, all of these are hard, but you can say it and it sounds simple, right? One is, are you who you say you are, right? So like, are you Mike Townsend? And then yes, if that box isn't checked, yes, do not go, right? We're not doing anything, right? The second one is, can you pay? And we can use services like Plaid and stuff to do an analysis to say, hey, here's the money coming in, here's the money coming out. This person can pay. Here's what their revenue, here's what their income looks like, and here's what that percentage would do to them. So it wouldn't cause too much stress, right? And then the last one is, will you pay? And will you pay is a lot about looking about characteristics of you as a human. And we try to use that last one through psychometric science that we've developed in order to essentially give you better pricing than you would get, better interest rates under the other one, and also to improve the quality of our portfolio. And so that's roughly what underwriting answers everywhere. And the computer can do a lot, the cloud systems can do a lot of analysis that takes into account those softer characteristics. And it's very important that it can also do it in like a uniform way across all people. It's not, it doesn't have any biases. It's all can be just built to be, will this person pay? And so I think that you can have a human touch in there, even though humans aren't doing it. Yeah,
that is fascinating to me. So the psychometric analysis that is not biased, what is not biased? Like what could be not biased about the soft assessment of a person? Because certainly if you were to just as a preamble to that, I feel if you were to just take a computer, analyze its society, and then draw out who is most likely to pay, you're going to get socially inappropriate responses. The computer is going to segment out by age, by gender, by race, by all the things that we as in like society doesn't like to draw lines around. Rightfully so, right?
So we haven't noticed that in any of the characteristics that we look at. And the primary characteristics that we look at is the way that you go through the application. Does it look like you're very likely that you want to use this for debt consolidation? And it turns out that someone who is desiring to do debt consolidation is very likely to repay their loan, like regardless of any of their other gender, race, whatever, any other characteristics. That's just broadly very true. The other thing that we do is and you can do this much more easily with models than with people, is that we can backtest every change to the model against everyone who's ever applied, not like a sort of like a simulacra of them, right? Since we don't keep personal information if we don't have to ensure that it doesn't introduce any sort of adverse selection. And that's something that all banks, when you're required to do, but all banks just like, I don't think there's, I don't know, maybe I'm just like Pollyanna, but I don't think that any institution is interested in wants to have any sort of adverse selection, right? We certainly do not. And so one of the things that you can do with a powerful, fully automated model is you can run it on a test across hundreds of thousands or millions of people to ensure that it's not there.
Walk me through. What does that mean? So you run a back test model on hundreds of thousands.
So you would say, look at everyone who's applied for the past 5 years, and whatever characteristics we happen to know. We of course don't know everything about people, and to ensure that when the model selects, it doesn't make a selection that adversely selects against any of those criteria, like age or gender or race. And then, if the model would, then you wouldn't put it into production. Got
it. Is that the same as saying if there's any differences between categories of people, then there's a bias in the model?
That's right. And then the model's not valid.
But wouldn't that have to be true? I mean, maybe I'm not understanding it correctly, or maybe I'm wrong. But if I were to say, take people in society that you've issued loans to, do a back test on the model, and say, out of everyone from 18 to 65, do an analysis, and if we find that there's any correlation with older people paying and younger people not, then the model is biased. It would seem like there's always going to be some uneven distribution, whatever line you draw.
It may be true that would come out in the model, but banks aren't allowed to do that. You have to ensure that your model doesn't do that. And so we do our best to ensure that our models do not provide any sort of selection based on criteria, even if we don't know them, that would introduce that kind of bias.
Yeah.
And it's anyone who does. I think actually the psychometric stuff is more robust because there's a lot of psychometric analysis that shows that that's kind of the same across all kinds of populations, and it's remarkably persistent throughout the ages. But anyone who uses machine learning of any kind is exposed to this. And I'm sure that they all do similar safeguards to the way that we do to make sure that they're not doing that.
But it is, if say you were to take the example of just accumulated money, and you look at people over any age range from 18 to 65, you're not going to find even distribution. Older people have more money just purely because they've been around on this planet longer. Yeah. I wouldn't draw a correlation to say that the model is wrong or the lending algorithm is biased in any way. It's just an observation. Is the observation in and of itself? I guess what I'm asking is, how do you parse out the observation from the bias?
So certain hard facts are permitted, like do you have the resources? Do you have the income to have this loan, right? Is your FICO score appropriately, right? Your FICO score is a score that is like, it may turn out that it's not, I don't actually know, but it might turn out that it has different scoring across people of different ethnicities or something. But those are sort of hard facts. It's when you get into the softer facts that you need to be extremely careful that you don't introduce anything that would select against someone. So like, you're very safe. And in fact, you're doing the consumer a very good service if you look at ability to pay, right? You wouldn't want to make loans to people that they can't pay back, right? I guess if you wanted to charge a lot of fees and penalties or something, you could try that. But in general, that's a bad idea. So those types of characteristics are kind of like hard facts. It's when you get into the softer facts that you want to be sure, both sort of morally, but also but also legally, that you're not introducing anything that would introduce bias against anybody.
Yeah. It's so interesting because there is a business case for it, and I think that's where the rub is. That's the friction point between society and its concern and society's concern for moral business practices. And then if you just look at it like purely from a utilitarian perspective, capitalism and business, it wants as much data as possible. The more data, the better modeling you can do. But there is some data which we view as not appropriate to feed into the model. Things like race, things like, I don't know if gender is, if you can do that or not, but there yeah, you can't. Okay. So what can you probably use location and then, yeah. So it's like this, it's this conscious.
You can't do zip codes either.
Oh, really?
Because there was a really long ago, there was a practice of redlining.
Yeah. Okay.
Which was a very bad practice. Right. And so now you really shouldn't do that.
Yeah.
And so I guess the answer is, from my perspective, is that like we've decided as a society that we're not going to use certain types of characteristics as things that we decide these types of things on. And I personally agree that that's morally correct. And you probably could find a way to make more money to do it that way, but it would not be the right thing to do.
Yeah.
And so,
well, similar to by analogy, it's like you could have a food company that makes, you're selling food, and or a healthcare company. Let's take a healthcare company. The healthcare company wants you to be unhealthy, so they have a problem to solve. The financial company wants you to need money so they can sell you money. And so there's like a checks and balances where every business is solving some problem for people. And so the business inherently wants there to be more problems out there in the world to solve, which is like the mission is, Uber's mission is to make transportation like water, like everyone gets exactly where they want.
Yeah.
Everyone, imagine that you snap your fingers, you walk through this teleport system, and then you're at your destination. Well, now Uber is obsolete. Now we're past that. And it's kind of the evolution of business is to evolve your mission statement. But it is kind of, I think, interesting to call that out because I see it happening in practice, especially in large companies, where they get to a point of solving the mission they set out to do. And then what happens is they have to preserve themselves. The organization has to stay alive. And so it keeps the problem going. And that's, you can see that in some industries more so than others, like healthcare, certainly. Changing a little bit directions. Crypto. Does Happy Money get into crypto today in any way, or have plans to, or do you personally spend time learning about or playing with crypto?
I know how crypto works, and I've been interested in cryptography for a long time. I worked with the team at. I actually managed the team at Netscape that built SSL. So I like crypto. And I like it for what it provides for privacy and those sorts of things. Non-repudiation, there's lots of like really important uses of secure cryptography. I'm aware of how blockchain works. I like not much with the cryptocurrencies. I haven't done much with that. And this is probably because my roots are in programming. I really like smart contracts because, like programmable contracts. What's not cool about that, right?
Yeah, they're smart.
So I like that. Right. Yeah. That's I really like that idea. And I think that will have legs in it. But otherwise, we work with credit unions. If credit unions wanted to offer lending products in a cryptocurrency, we would certainly do it. But we provide no. We are a technology company. We provide no assets to lend. We don't actually lend any of our own money. It never leaves our books. And so we haven't heard a request for that yet. They are very conservative in terms of like crypto will have to be very broadly accepted, maybe even accepted by someone like the Fed before the credit unions would move.
Yeah.
I think there might be other interesting applications, and we're certainly open to it. And certainly, if someone had a cool smart contract idea, that would be good for us. I'd be open to that as well.
All right. Well, you put it out there in the world. People are going to listen.
Right. Yeah.
So you were director of engineering at some pretty cool companies, Stripe, Twitter. I think you were at Uber, obviously Goldman.
Yeah.
I assume now leading Happy Money with the size of the company, you're not spending your time in terminal and a code editor day to day.
No.
When you were director of engineering at those companies, what was your day-to-day like in terms of you're managing a team, presumably it's hundreds of people, or you're overseeing even thousands of people. What were the types of, I don't know if I want to say lessons learned, but as you became better at the job, just in having done it longer, what did you do differently sort of in the later roles than earlier? Like, where do director of engineers make mistakes if you were to coach people on that?
So there's sort of two classic areas, and they're like the two sides of one coin right there. One is, as you move up, you can stay too close to the day-to-day coding and everything, which then makes you like super annoying to everybody. You're always like poking into the code. You're not doing your management job. You're not helping to be productive. You're not providing the leadership and the guidance that you should provide. And by the way, as a manager, that's your only job, is to create an environment where your people are as productive as possible. It took me a little while to get that through my head, but once it was through my head, like I was pretty good at remembering the one thing that was my only job. And so I think that there's that. And then sometimes folks go too far off the other end where they become just an administrator. And now, why do they add any value managing the engineers other than that they were one at one point over anyone else? And so I think that as I did it a few times, I learned to calibrate where to sit in terms of I'm providing leadership, I'm providing opportunities, I'm providing guidance for people, I'm actually do the management job, right? So that people get career advancement and get challenges and get the right things delegated to them. And then sit at the right place in the technology stack where I know how the technology works, what's going on, and I can sort of communicate that to my team, the team I'm on, not that I run, which will almost always contain people who are non-technical. And so you need to learn to communicate complicated technical concepts in a non-technical way so that the broader team can participate in the decision making. And that's really a part of your job, is not just make the decisions, but communicate so that everybody can participate in that. And there's sort of like two places where I think it's demonstrate the right level of tech touch. There might be more, but here's two easy ones. One is, and the second one I really love, so maybe it might not be the best one, but I love doing them. The first one is to participate in actively the architecture of the system as it goes together. So be a part of that, read it, be engaged with that, provide your feedback, learn from the architects who are more close to the technology than you are now and are going to help teach you and keep you at a place where you're a technical manager, not just a manager, right? And the second is there's this thing when a site has an incident where afterwards we do what we call a root cause analysis meeting. And that is exactly what it means. What was the root cause of this? And for me, I not only like to read all of those when I come on to a new company, but I like to attend those every week because, and I said this might be a quirk, for me, when I see all the ways something breaks, then I know how it works. So if I see it breaks here, it breaks there, it breaks there, oh, now I get a sense for how this thing actually works and holds together. And it's pretty important to know that when you think about the new kinds of things you want to do with it. So that's and it's a lot of hard work. Right? It's hard work to manage engineers. Yeah.
When you first get into a role, do you schedule one-on-ones with everyone right away? Is there a couple things you would do when you first join an existing team?
So one is, I picked this up at Stripe, is I have a document called Working with Jeff that tells you how I work, what I like, how I express appreciation, how, like that I value radical candor and absolute transparency and that making mistakes is okay and things like that, right? It's about 3 or 4 pages long. I tell everyone to read that and I publish it as broadly as I can at the company for everyone to read. There's no secrets in there, and everyone reading it helps me make it better because they'll say, oh, here you're kind of lying. You actually do this. And I'll make it right? And so that's the first thing. And then there is the second one you already mentioned. There is absolutely no substitute for one-on-ones with the people that you manage. I always do them, and I always do them every week.
Really?
And it's just important to give. You're managing someone, they're a full-time employee, and they aren't worth a half an hour of your time a week. That's ridiculous. Of course they are.
Yeah.
And so I don't bend on that. I make those happen every week.
How many would you typically take at the most?
So I think that in order to give the right level of attention and the right care and the growth for someone who's like a complicated creature, like an engineer, you probably shouldn't have more than 8 people. And it probably doesn't make sense for you to be a manager at less than 3. So, maybe a team lead or something, and help you build those skills. Good one-on-ones is hard to do.
Yeah. What do you kick off conversations one-on-ones with? Do you say casually, how's it going, and just let people vent, or do you approach it more structured?
So I like to keep either a Google Doc, I love Google Docs, or, if we have a tool at the company, a list of items that we're going to discuss. And I actually start every one-on-one with reminding the person that it's not a status update. This is their time. And we're going to talk about what they want to talk about. This is the time where they're telling me what they need from me. And so I will occasionally, if there is an urgent performance issue to discuss, I'll put it in there, but I prefer to schedule a different one so that time sort of remains sacrosanct, to say, no, I should always keep my one-on-one with Jeff because it's my time. It's a time when he listens to me and when he's finding out what I want and tries to solve things that are important to me. And so I usually provide that framing at the beginning of each one, probably to the point that it's annoying, but I want to be sure that the person gets it, that don't come in and tell me the status of all your projects. That's not what this meeting's about. This meeting's about other things. And some folks are better at using that than others. If they aren't, then I find that just as you mentioned, the casual conversation, hey, what's going on this week? We'll often get them started, right? And that can be helpful.
Yeah. And sometimes I'm sure you must have witnessed that it goes into pseudo therapy, where people start talking about, this person is tough to work with, or this goes on in my personal life. And is that the case?
It is a good forum for someone to tell you what's going on in their personal life, because that helps you have context for why maybe they're not performing at work, right? And it helps you to offer things that they might not ask for, do you need a leave of absence? Do you need some time off? Is this a way that we can help you to, get back on your feet or get your mind back in the right place? And that's important. It's important to provide the space for someone to talk to you about that. And I think if you didn't provide that, the one that I discourage, and again, I think I have a lot of annoying habits, but anyway, is that if someone complains about another person, I'm not sure where I picked this up over the years that I've been working many places, but they'll say, oh, so-and-so is such, and I'll be like, oh, and what did they say when you told them that? And they're like, oh, well, I don't want to tell them that, right? And it's like, yeah, well,
yeah.
The three of us meet and we talk about it, right? Because you don't want to become too attuned to the whiniest person. You don't want to make decisions about someone else without hearing all of their input. And ideally, you'd like people to build the skills and practices of handling these difficult interpersonal things with each other, because it's good for them and it's good for the company. And it's way unrealistic to expect you're going to build a fast-growing, hardworking organization where these things aren't going to happen. They're totally going to happen, right? And so I usually have found that kind of the more you don't want to talk about something, the more you should talk about it.
True in personal life too. Whether if you have a spouse or yeah, that's absolutely true. Did you do a similar maneuver when you joined as CEO? Or sorry, you joined as CTO and then became COO. In that transition, CTO to CEO, was it a big transition? Was it incredibly smooth?
It was.
Yeah.
So my transition was I was hired as the CTO, and then I moved to be the chief operating officer for a few months, and then I moved to be the interim CEO and then the CEO. And because when I moved to be the CEO, the old CEO and founder was leaving, that was necessarily a big transition. And the reason behind that was that Scott and the whole board actually felt I was a very good person to navigate building this technology platform. I'm fundamentally a technologist, right? Of APIs. And I've also worked a lot with partners, and I'm good at operating things, right? Lots of engineers now don't just write code, you operate complicated services. So you build these good operating skills. And so that was quite a transition from someone who was more from the business side, more baked in just sort of the vision, and tended to rely on someone else to implement it. And so, so I had lots of one-on-ones with everybody. We did this was during COVID. We did lots of as many get-togethers online as we could. We did a couple in real life get-togethers, which was incredibly difficult given all the restrictions and stuff in order to build those relationships. And then constant repetition. In some ways, like starting something new is way easier than changing, because when you're changing, people have the old way and you have to constantly repeat what the new way is and help people make that transition. So I think it took, about 2 months for us to make a good, solid transition to be a functioning executive team again. It didn't seem out of line to me. It seemed sort of expected that that's what would happen.
Yeah, sounds right. Especially given that everybody's remote, it adds an extra level of, human beings are animals, and we like to be around each other to build trust. You don't necessarily have to be around each other to be productive. I think a lot more people are productive when they're not distracted by other people, but certainly you can't just be productive and have a culture. A culture implies a relationship between people. Do you think that bringing people together every day, sometimes per week, sometimes per year, what's your thought on building culture in a largely remote world that we're in?
So there's sort of three things I think about that. One is you need to recognize that the organization is distributed, and you need to be really intentional about your communication. And I only worked at Happy Money 2 days before COVID happened, and then we became distributed. So I have experienced what it is to have a new job and be distributed. We decided this was a real thing that was going to last more than 2 weeks, so we leaned into it. So the first thing we did was we reviewed all of the ways that people learn about what's going on at the company and became really intentional about writing that down, sending it out, over communicating. And then we did surveys on it. It's actually interesting that we got feedback after a few months that people felt better informed than they had ever been. Not now we're the same. It's no, it's way better than it was when we were all in the office. Because you get lazy and you rely on just the office, right? And the second one was to be very intentional about the use of written documents in general, because it isn't easy to go ask someone. And you want to be sure the stuff is written down and accessible, and you can read it and you can get the answers from reading it. And then the third one is to focus on as much in real life as we could. For the first year, we could do almost none, right? It was so restrictive. And the second year, we did team in real life meetings, which helped somewhat. And now we're more focused on an all company in real life, which will be a combination. And we're going to do at least one of those a year and see how that works. And we'd like to do more. We're just trying to figure out what's the world of these restrictions going to be like. And then the other thing that I do personally, so I'm the CEO, first time as a CEO, I am very allergic to organizational distance. I don't want there to be any between me and anybody else. And so I do a bunch of things, like I do weekly coffee chats. I write a weekly email to the whole company. I run an all hands. I do office hours. And all of that is to make up for the fact that you can't just come and stand by my cube and ask me stuff, right? And in general, we've had, feels like a lot of artifice, but in general, the feedback is that people appreciate the availability. So I'm hoping that as we get past all these restrictions, we can make more use of meeting in real life. And I think that will add on top of what we're doing now. I think we've done a pretty good job of having everyone feel connected by being so intentional about how all the connectivity is going to work, and really thinking about where problems might occur and how we could fix them. Yeah.
I really appreciate your thoughtfulness around all this. So a lot of what you were describing is communication methods with other people on the team. How do you think now, as having run the technology portion of many companies and stepping into this new leadership role, where I think of the CEO as being distinguished from the CTO and other executive roles as articulating the direction of the organization and how we're specifically going to go in that direction. And so figuring out the direction, do you have an organized approach to like continually renewing the direction? Because certainly the world changes, you learn new things, you build products that fail, and you have to change directions.
Yeah.
And oftentimes they're not like major changes. You're still offering financial services to people, but maybe it changes in some significant way. Do you have a practice of journaling or writing, or how do you go about processing all the conversations you have into like a clear, articulated pathway forward?
So like to start off with one, you're right. The CEO job is a little different. The CEO is responsible for the creation of. He doesn't have to create it themselves, but everyone can help. But creating and maintaining the vision and mission of the company, and setting the culture of the company as well. Those are two things the CEO just has to own and do. Now, I'm a very team-oriented person, and so the team, we work together to develop that, but then I have to be the face of that. And what you mentioned on the second one, I actually think comes from my engineering. And while we have a fairly open discussion process, again, based on written narrative documents in Google Docs, in fact, I like that written down. I like people to put their comments in. I like to keep the comments. I like to have it written. And every time a new person reads it, I like to take their questions and get answers. So it gets better and better, right? But from the engineering background, there's this Agile engineering practice, or lean startup practice from Eric Ries or someone like that, right? Where you want to run the smallest experiment you can, take what you learn from that and iterate. And we were doing that in the engineering team at Happy Money. And if we hadn't had tech debt, we would do it better, but that's getting burned down. And so I'm bringing that as an intentional process. So every month we take everything we thought was going to happen, all the forecasts, and we look back and we see if that violated any of our assumptions, if there's anything we should do to change the course, and we reevaluate what we're going to do in the next month, every single month. And we do it in a pretty structured way. And this is like, because of the stage we're at, like when you haven't launched, that's different, but we have a very significant lending business. And we also are launching new lending products. We're launching new APIs. We're getting into other businesses to help the credit unions as well. And so we want to be sure that the way that we spend and allocate our resources is appropriate to the existing lending business and helping that to grow, and to growing new businesses that will, provide for the long-term strategic growth of the company. And we do that in a pretty intentional way. And we, for better or for worse, we reevaluate it every month, like to see, did anything change? We also look, did our competitors do anything this month? Did something happen in the marketplace? So much change in the world that I'm not sure how, I don't know. I've never really been able to like think about a 2-year plan and have it come out, right? And so like, I'm not sure how you do it now. Everything changes so fast, right? It's much better to have like a general destination and then sort of, I don't know, wander your way toward it.
Yeah. Yeah. Do you tune into any sources of outside news consistently, whether they're like people on Twitter or articles or writers, bloggers, journalists, anybody that you feel is distinguished in their quality?
Probably two people, most common, and one's way more prolific than the other. So having worked with Patrick, I have a huge amount of respect for Patrick. And so sort of anything Patrick says or talks about, I'll generally follow it.
This is Patrick Collison from Stripe?
Patrick Collison, yeah. He's super thoughtful, crazy smart person. And so almost anything he writes or says, I will read it. And then the other person is Reid Hoffman. Just like one, like amazingly successful individual, but also just really thoughtful, really helps you think about general long-term trends. If there were someone else that I follow, I will typically look at what people from Andreessen Horowitz say as well. it's funny. I think I tend to follow people that I have known, right? And so I get a sense of who they are and how their brain works and the incredible contribution that they have. So those would be the sort of the biggest ones, with probably Reed's writings being the most influential on me.
Yeah. Well, when you put that much thought into what you're writing about and have seen as much as he has, it's like the combination. You could be incredibly thoughtful and you could spend all your time writing and reading, but unless you have that insight into what other people are doing in boardrooms that aren't public, it's like you just can't quite see the same thing. He has a unique visibility that, it's smart to read what he's writing. Awesome. Anything else you wanted to throw out there, Jeff? I really enjoyed hearing from you. Anything that keeps you up at night? Anything you're worried about, or anything that you want to throw out for Happy Money? Obviously, people can check it out. I love the branding. I like the idea of making people happy around financing. Brilliant model of empowering the credit unions to facilitate loans through APIs and direct to consumer.
The only other thing I'd throw out there is that, like, for me personally, one of the things Stripe is a wildly successful and fantastic company, but one of the things that I really like there, and I hope we manage to accomplish by publishing our own lending as a service and eventual banking as a service APIs, is to become part of that formative entrepreneurial and developer community. I really liked that. I liked having so many developers use what we're building, so many entrepreneurs thinking of cool ideas. And I'm hoping that we can accomplish something similar with Happy Money, where we become the focus of the creativity of all those people in terms of what they could do with the tools that we're building. It's just super rewarding for me.
Yeah. I think you should also do some, I'm sure you have, but I think you're a really clear thinker and you have a lot to say from having been at some of these awesome companies. So I'm just poking you to put more written content out there. Well, I'm glad you joined the show today. It was really exciting and insightful to get to know you a little bit. And congrats, and wish you the best of luck with everything.
All right. Thank you very much.
All right. Cheers, Jeff.